Welcome to this explainer. Today, we're diving right into the foundation of international public sector accounting standards. We're going to explore exactly how global rules govern the tracking of public money and, why the way a government reports its finances looks so incredibly different from a private corporation.
Here's our roadmap for today. We'll hit 1. The global standard setters. 2. Defining public sector reports. 3. Who reads these reports? 4. Accountability and decision-making. And finally, 5. The 6 quality characteristics. Let's break this down and see how these abstract global rules become tangible, vital insights for you, the taxpayer. Section 1. The global standard setters. Let's start at the very top of our accountability funnel and look at the authorities who actually write the rules. The framework we're looking at is driven by 2 key organizations. On the left, we've got IFAC, the International Federation of Accountants, and on the right, the IPSAS, or the International Public Sector Accounting Standards Board. Now, IFAC provides the support and funding, but it's the IPSAS that operates independently to actually develop these international standards. They're literally the architects behind the reporting rules we're unpacking today.
To really wrap your head around the sheer scale of IFAC's influence, just look at this number. They represent over 3 million accountants across 135 countries. We're talking professionals in public practice, government, industry, and commerce. So this isn't just some small committee in a basement. It's a massive, globally coordinated effort to strengthen the profession and guarantee high-quality international standards.
Section 2. Defining public sector reports. Okay, so now that we know who sets the standards, let's drill down into the overarching purpose of the reports they actually regulate. This entire framework hinges on GPFRs, or General Purpose Financial Reports. By definition, these are reports designed specifically to meet the information needs of users who can't just demand customized financial reports. Think about it. A major bank lending out billions? They can demand a custom report. But you, as an everyday citizen, you rely entirely on the GPFR as your main window into the government's financial house. So why do we even need specific rules for the public sector? Why not just use corporate accounting and call it a day? Well, unlike corporate reports, these public sector documents have to account for some pretty unique scenarios. Governments deal with a massive volume of non-exchange transactions. That's really just a fancy way of saying taxes, where you pay in but don't get direct, immediately equal value back. They also have to measure performance against a strictly approved budget, manage programs that might last for decades, and account for highly specialized assets. A national park or a military base isn't held to generate cash flow, right? It's held purely for its service potential.
Section 3. Who reads these reports? So if these reports are designed for folks without insider access, who exactly is peering through this financial window?
The framework zeroes in on 2 primary user groups. On one side, we have service recipients. These are the people relying on government services, public education, policing, national defense, the whole shebang. On the other side, we have resource providers. These are the people footing the bill, like taxpayers, lenders, and multilateral donors. And obviously, if you're a tax-paying citizen, well, you fall squarely into both of these categories.
Section 4. Accountability and decision-making. Let's take a look at why providing this specific info is absolutely crucial for a functional society. The core philosophy here is perfectly captured in the handbook itself. It states that governments and other public sector entities are accountable to those that provide them with resources and to those that depend on them to use those resources to deliver services. It's a two-way street. It's not just about tracking the money coming in, it's equally about proving the value of the services going out. Financial performance in the public sector isn't about hitting profit margins, it's about successfully achieving service delivery objectives.
When they're done right, GPFRs empower you to make some pretty critical decisions. Because let's be real, you can't just switch your government service provider like you switch cell phone carriers. Your decisions mostly take the form of voting preferences. These reports help you follow a really logical flow. First, assessing past performance and budget compliance. Second, evaluating the government's current standing, stuff like liquidity and solvency. And third, predicting the long-term sustainability of those services you and your community actually rely on.
Section 5. The 6 quality characteristics. This brings us to the very bottom of the funnel, the specific mechanics and rules that make sure these reports are actually useful to you.
The framework lays out 6 qualitative characteristics: relevance, faithful representation, understandability, timeliness, comparability, and verification. Think of these 6 traits as the cleaning solution for our metaphorical window. They keep the view into the government's finances clear, sharp, and totally free from fog.
Let's quickly step through each one, because they're absolutely vital to making sure the data you see isn't just a bunch of noise. First up is relevance. The information in these reports can't just be a massive data dump. It has to actually make a difference in achieving the objectives of financial reporting. Relevant data either confirms your past expectations about how resources were managed, or it helps you predict if the government can handle future service demands. If it doesn't do either of those things, it's literally just taking up space.
Next, we have faithful representation. This means the report must show the genuine economic substance of a transaction, which, surprisingly, isn't always the same as its legal form. For this to work, the depiction must be complete, it must be totally neutral, meaning no bias or intent to manipulate behavior, and it has to be free from material error. Basically, it needs to reflect reality as closely as humanly possible, no hiding the ugly truths or inflating the good ones.
Then there's understandability. The standard assumes that users already have a reasonable knowledge of the government's activities and are willing to study the information diligently. So, while the data shouldn't be dumbed down just because a public sector program is highly complex, it absolutely must be presented clearly and concisely. A diligent citizen really needs to be able to comprehend it. Timeliness is our fourth characteristic. This one's pretty straightforward, but man is it important. A brilliantly compiled, flawlessly accurate report is completely useless if it arrives 3 years too late to actually influence your assessment of a government's accountability. The information has to be available before it loses its capacity to be useful for your decision-making.
Now, comparability isn't just about consistency. It's about enabling you to identify similarities and differences across time periods and between different entities. By using consistent accounting principles, you can look at this year's budget compliance and accurately compare it to last year's. You can even look at a neighboring jurisdiction providing similar services and see exactly how your own government stacks up.
The final characteristic here is verifiability. This is what guarantees the numbers aren't just pure fiction. It means that different, knowledgeable, and independent observers could look at the exact same data and reach a general consensus that it represents reality. This can happen directly, like literally counting stacks of cash, or indirectly, by checking inputs and recalculating the outputs using the exact same methodology.
Now, standard setters are pretty pragmatic folks. They know absolute perfection is impossible in the real world, so they acknowledge 3 pervasive constraints on this information. First, materiality. The data actually has to be significant enough to matter to the user's decision-making. Second, cost-benefit. The financial and administrative cost of reporting a piece of data shouldn't totally outweigh its benefit to the public. And third, sometimes accountants just have to strike a balance between those 6 qualitative characteristics to get the most useful report out the door.
And speaking of balancing, to really support the neutrality of these reports, the framework requires something called prudence. When dealing with the massive uncertainty of government programs, accountants have to exercise caution. They have to make sure they don't overstate assets or revenues, and, super importantly, that they don't understate liabilities or expenses. Essentially, they cannot paint an overly rosy, optimistic picture of a government's financial health just to make the current administration look good.
Which brings us to the very end of our funnel. So, now that you understand the global framework that builds this window into public sector finances, the standard setters, the users, the push for accountability, and the 6 traits of quality data, the crucial question really remains for you to answer in your own community. Is your government's financial reporting faithfully representing reality? I highly encourage you to go find your local government's GPFR and look through that window for yourself. Thanks for tuning into this explainer, and keep learning.